have Francis Birkeland from ABN AMRO Bank, Michael Parker, who's industry head, Global Shipping and Logistics from Citigroup, Evan Uhlick from DNB Bank, and Martin Van Tool from DVB Bank. Given that time is limited, I'm just going to jump right into the questions. And our first topic is just going to be the state of the shipping banks. As almost everybody knows, the number of traditional shipping banks has dwindled over the years, and many banks that had stuck it out are now starting to leave because of their legacy losses. The shipping banks that have remained have generally funded their best customers. So I asked the panel, do they view this as a fundamental shift that will result in just a few traditional shipping banks remaining that only fund a select number of top customers? Or is this just a cyclical reaction to the boom-bust nature of shipping? And you want to just run down the line and start with you, Francis? It's your first.
Yeah, thank you, Tony. No, I don't think it's a permanent situation. I think it's reflecting the cycle. Indeed, at the bottom of cycles, you see banks getting out, and it takes time to see them coming back. But in fact, I've already spoken to certain banks which did go out some time ago, and they are reconsidering, shouldn't it be the time to get into shipping again? Margins are relatively healthy. Covenants leverage is much lower than what we saw, many years ago. So I'm more on the cyclical guy, saying this is just
the cyclical response. Yeah. Michael?
I'm not sure I agree. I mean, I think the difference between this cycle and previous cycles is the fact that bank regulators have taken a great interest in this industry like never before. And so it seems to me the risk is that if the picture that James Frew painted, which I liked because it was a very positive picture, if that came to pass and attracted a lot more banks, it will imply a weakening of credit standards. It will therefore imply potentially, a weakening of, cycle that will come again, and the regulators will be very concerned about that. I think with the pace of consolidation taking place in other sectors, I think the role of the capital markets will become much more important. So the need for other banks to come back into the industry may well be less if you also consider Chinese leasing companies and other forms of capital. So I'm not disagreeing with Francis, but I think there's more doubt this time that we will see other banks coming back in as they did before.
Evan?
Yeah, I might just turn the question around a little bit. The question almost has a negative bias towards the banks, but if you look at the industry over the last decade, you've seen a real decline in the overall number of transactions, the overall number of ships ordered. It's not to say that they're not very good clients out there still running profitable operations and seeking good needs from the bank community, but the total quantum of maritime capital markets, banking, finance activity has declined on a relative basis over these last 10 years. And there is just not enough activity within the industry right now to warrant that much kind of banking activity. I would also say this, when you look out at doing a tanker deal or a dry bulk deal in this market, it's very hard to make the break-evens work. The rate environment that we're in right now is quite challenging overall. So from just a credit risk perspective, you've got to have a bank with certainly a history in the business and an understanding of the risk that you're taking and how to finance that risk in a proper way.
And Martin?
Yeah, I think it's more cyclical than it is permanent in the end. And Michael's comment on the regulatory is definitely valid. But there's ultimately a pricing around that, so that will get factored in the long run. I've noticed over the years that memories are short, actually. So people, terms are nice again, so you'll see new entrants and good deals being done and people catching on to that, and before you know it, it is an industry that is, bankable again, and attractive in terms of returns, and a lot of banks will return to the space. If you go mid-80s, coming out of that, banks were offshore back in the days also. Banks vowed never to do it again. I joined NIB in the days, and they still had a drill ship on their balance sheet. And yeah, that's all forgotten, and people got crazy again in the 2000s. Memories are short. People move from credit committees. New guys are there who don't have not the long-term memories like we have. Memories are short.
Do you think that just to touch on the the turnover in the maybe not necessarily the institutional players, but the people that run them, do you think there's a fundamental shift in this part of this cycle in that you now have the banking regulators chasing you? Are they going to give a permanence through these regulations, or like in many cases, regulations change too? The regulators change, and then people forget, the regulators forget the problem, and they're persuaded to reduce the regulation, and then you start it all over again. Is that something you think is going to happen here? Or?
No, that will stick. So once you have certain capital requirements for asset-based financing, that will stick. I think it will be very hard to reverse that. Consequence of that being that price of capital for shipping companies will just be higher. But the more attractive it then is for people to start doing those deals. So there will be some department at some bank that discovers it and say, listen, why are we not doing this? This is attractive business.
Francis,
I think I agree. The regulator, the cycle of the regulator is definitely much, much longer. I mean, the shipping cycles are 7 years. The regulator maybe every 50 years. So I think I agree with Michael's comment. As such, the regulation is changing the ship finance world almost permanently. I don't necessarily disagree. I agree that the banks will not have won't have a role to play. But I don't think the tough regulations which might come or have come and are coming, they will not be relaxed anytime soon.
Not to go too far off topic, are you suggesting that the banking regulations are actually going to become tougher for shipping banks? Or?
Definitely. The so-called Basel IV rules could make it terrible for us, not giving us any value for the security in a mortgage.
Wow.
I mean, Basel IV will kill shipping finance.
Yeah.
Mm-hmm. So, and I think we can all live with Basel III, and I think maybe given the direction in this country around the implementation of regulation, maybe Basel IV won't come. But I think the other reason why the cost of shipping, the previous panel was sort of touching on it, the cost of shipping is going to go up through increased regulation. And I think the question that we wouldn't have had time for would be, at what point will the US Coast Guard and the IMO actually work together? But at that time appears to be getting closer. So it's just going to be more expensive to be in shipping. Now, consolidation will take care of some of that because stronger companies, more creditworthy companies who will have easy access to other markets, they won't need banks for the same long-term financing that historically they have. So it's not that it won't be attractive, but I think it will potentially become a more marginal business for some banks, simply because of the nature of how those bigger companies choose to, what capital structure they choose to have.
I don't want to give the audience the impression, though, that there are not going to be opportunities and there are not going to be attractive ways for shipping companies to finance themselves. Far from it. I think shipping is quite vibrant and quite resilient in finding new sources of capital. That's probably why we're here today. I just think that the days of having 100% bank capital structure where it's just senior loans from 15 well-known banking institutions, those days are not over, but they're dwindling. And I think more and more you're going to see more varied types of maritime companies' capital structures be put in place to confront this heightened regulatory environment that we're entering into.
And just to touch on something you said, Evan, and Michael touched on consolidation. So what I'm hearing is that the consolidation and the fact that shipping companies are looking into alternative sources of capital cuts down the demand on banking, for banking loans. Is that kind of behind what you're saying?
Yeah, I think it's a push and a pull situation, though. You know, I think what you're hearing from the panel is Basel IV, as well as, you know, countries' own internal regulators and banks' internal regulators are putting a big squeeze on the ability for, you know, shipping bank groups to do good business. But at the same time, I think for the maritime industry to professionalize and grow in terms of its corporate governance and become more attractive to the investor community, having larger, more consolidated vehicles is actually quite interesting. The one thing we're hearing a lot, you know, from investors these days is having larger companies, larger market caps, more share liquidity to make a more investable vehicle. So I think it goes in both directions.
Credit rating. A lot of shipping companies don't have a credit rating, so alternative to simple term loan financing is not available to people. And if you can get your credit rating solved, that issue solved, you open yourself up to a lot more possibilities. And to Evan's argument, indeed, if you are, instead of a shipping company, a corporate that is active in shipping, then maybe there's a US banking market that just wants to bank you on your balance sheet. It's not easy, but that's certainly not available today.
And Michael touched on the Chinese banks and leasing companies coming into the market. Do you believe that they will continue to come in a big way? Are they going to supplant the role of the traditional shipping bank, which usually we think of as in Europe and to some extent the United States? Or are they going to hit a point where they just will not expand any further? Is their focus really on just financing the construction of vessels in Korea and China, new builds and whatnot? Or are they going to reach out and really say, oh, we're going to make a lot of money by lending to these shipping companies?
The leasing companies are not only doing new build, they're doing second-hand as well. So clearly they are helping to fill the gap, because there is a big gap in terms of active shipping banks. Even if the new regulation is not there yet, we're speaking about Basel IV, but there's a possibility for it. We are missing a few banks when we try to close larger transactions. And the Chinese leasing companies have provided, you know, enormous amounts of funds recently. So, yes, they're bridging the gap. Are they going to be there long-term instead of banks? No, I think they're going to be there long-term in one form or another, but you shouldn't choose between senior bank debt with your relationship banker next door and a leasing company who owns your assets out of Shanghai.
Do you see, just to follow up, do you think there are going to be any traditional, well, not traditional, but Chinese banks or other Asian banks following a traditional shipping bank model where they'll actually do the loans and not own the assets? Is that something they're just not interested in?
We're not seeing the Chinese banks so much in the Western syndicated loans, but obviously locally in China and in Asia, they're much more present.
Okay. Does anybody else want to comment on that?
I mean, I think you need to see the Chinese lenders in the context of obviously initially supporting Chinese shipbuilding and other Chinese interests. And I think you also, context of One Belt, One Road, or whatever it's called now, it's a economic policy of the government that Chinese shipping companies should carry 15% of all China trade, and they're not quite there yet. So the banks are part of, if you like, fulfilling that long-standing objective. As we discussed on a similar panel in London a few weeks ago, the issue any Western ship owner has is at the point at which a Chinese lender or leasing company provides most of their capital, what happens to their relationships, their traditional relationships with Western banks? And that, you know, raises some issues, cultural issues, if you like, around what happens when you need a waiver, what happens when you need an amendment. I don't think the Chinese banks will lend nearly as much as, say, the German banks did in the last 20 years. And I think it'll still be very much more tied to Chinese cargoes, Chinese ships, and therefore it will be an important contributor to the overall financing of the industry and the industry's infrastructure. But I don't see it being a danger that we've seen from the last 20 years.
Anybody else?
I'm personally fascinated by the Chinese leasing product. It has emerged on the scene in a roaring way. I'm very interested to see it tested through the cycle. In particular, they loaded up on a considerable amount of dry bulk and offshore assets, and I'm very interested to see how that plays out in terms of working out a Chinese leasing product.
Martin,
No, I agree. I mean, what happens if you need a waiver? Who's going to pick up the phone, and who is going up the chain, you know, asking somebody something to their board that is not going to add any revenues? That's culturally also a little different. Right. So still to be tested.
And shifting around to England, I want to start with you, Michael. How do you see Brexit affecting shipping banks? Do you see it affecting shipping banks at all, or is it?
I think you mean Britain, not England. We had a legal referendum and we're still a United Kingdom. Brexit, I think, is fairly irrelevant, except for the fact that post-Brexit, the United Kingdom will sit separately in the IMO and not be part of the European Union group, and therefore have more influence as a seafaring nation, if you like, in the debates that go on at the IMO. And I think that is a big opportunity. The issue for the UK clearly is really making sure that its own whole maritime sector, services and equipment, all those things are invested in heavily to help the UK trade with other people. But I don't think Brexit really has any relevance to the broader topic of shipping.
Okay. And shifting to kind of the structure of loans, when I was kind of growing up in ship finance, many of the loans that I worked on as a lawyer were syndicated loans, and I really don't see those anymore. This past year, I've spent most of my time in restructurings and not many new deals. So I'm just wondering, and in the restructurings I've seen the banks fight among themselves a little bit occasionally. And we didn't represent any banks, by the way. But do you think syndicated loans are completely gone? Is it just a reaction to the current stress in the market and banks not wanting to kind of be behind the lead bank and having their interests suffer? Has there been a fundamental change in how loans are packaged these days?
Yeah, sure. I think it's, as you suggested, clearly the reflection of the weak markets. Many banks have exited the space. Those who are still in are knowledgeable. They want to be part of the structuring of a deal. The typical syndicated loan, you would invite banks willing to more take a ticket, rely on the main banks. You don't have so many of these banks today, but when some of the banks who exited will come back again, I think they're clearly going to restart the syndicated loan markets. And just you have large syndicated loans, but I would say all of them are large club deals, meaning that all the banks feel that they have a say in the structure. In reality, what's really the difference between a syndicated loan and a large club deal? You still only have one agent bank. You have some banks taking a larger part of the process. So yeah, you do have some kind of syndicated loans, okay, but not with the old-fashioned stuffies who would never go out of their office in a booking location somewhere.
I think it's partly a function of the declining order book. I mean, the first half of the year, if you look at the Dealogic statistics, they're sort of very, very strange, but they're probably consistent that the year as a whole will be still lower than 2016. I agree with Francis. You've had really syndicated loans are going on, but they're really in the form of clubs, whether they're in restructuring or new deals. We're working on a number of large syndications that will come to market at some point in the next 6 months. So I think as the new order book rebuilds, hopefully mainly for replacement tonnage, so you'll see more syndications. But what is happening is that there is liquidity elsewhere in the market that may not come in the form of a traditional syndicate, but where banks are able, if you like, to raise additional liquidity through silent sub-participation and other means. So the investor, the bank, if you like, or quasi-bank investor appetite for shipping is definitely picking up. But the straightforward syndicated loan has just been rather quiet this year, but I think it'll be back next year.
Okay.
The only thing I would add to that, I think there's something to be said. You mentioned restructuring, and you've been working on a lot of restructurings. It's not clear to me that these mega bank syndicates are good for owners when you get into a tough situation. The markets are roaring ahead, and you need, $1 billion or $1.5 billion. Yes, the syndicated loan is really one of the primary avenues to get that funded. But as we've seen certainly in the last couple of years, when you have these large, unwieldy syndicates, it's very challenging for borrowers to affect amendment processes or meaningful restructurings. It's actually a hindrance to many borrowers to do that. Whereas if you fund yourself through smaller club deals, club syndicated deals, it's easier to massage some type of amendment process or some type of tweak to the overall agreement.
Martin, do you want to add anything?
Well, nothing to add. I agree with that. I mean,
Okay.
careful what you wish for. There's not the number of large transactions in the market that we saw, 5-10 years ago. A lot more is one-on-one, bespoke, and if there's a larger deal where one bank, can't lift it, you call a colleague and say, you guys want to join on this. It's that kind of market at the moment.
The part of the problem goes back to the conversation about regulators. DNB and Nordea were great examples of being willing to underwrite large positions in the past, and the pressure from regulators on large hold positions just makes it more difficult. Now, some of the restructuring has involved very large syndicates, particularly in the offshore space. But, I think going forward, shipping syndication has really always been about clubs. And the real question is, if Francis is right and the cycle reasserts itself and attracts a lot of other less specialized banks to come in, what will then happen? Well, historically what happened is they were often the first to leave, but also they were the ones who didn't understand what they had done and therefore created problems. So in a way we have potentially two problems. One is we'll have less industry-focused banks coming back in, and we'll have smaller holds from the specialized banks because the regulators won't let them hold large positions. But I tend to be of the view that the large volume will tend to go more towards the capital markets as opposed to the bank market as the industry grows again.
And we've talked a little bit about the borrower side, and I'm just curious, everyone's reading about new container ships coming out with enormous TEU capacity. And one question I have for the panel is, how do you view financing for such a vessel? Does the size, the sheer size of the vessel, and the fact that the number of users out in the market is, if something came to pass where you had to sell it as collateral, does that affect your front-end lending?
Well, I'm first out again.
Just keep going down the way.
Yes, we have security in vessels, but we're not financing just the vessels. We finance ship owners, which for us is the number one criteria. Who are you dealing with? So the question, what do we think about financing 22, 26, 30,000 TEUs, whenever that happens? It depends for whom. If it's a large operator, he needs the vessels. Maybe he has a good balance sheet as well. Of course, that's not an issue. If you're a tonnage provider today in the container space, you don't have any long-term employment. It's going to be difficult, and we're going to definitely focus much more on is it the right size or not. So the answer, yes, we're going to finance the big vessels for the right people.
I think container shipping, and if you look at Maersk's strategy, container shipping won't bother to use the word shipping in a few years' time because it's part of a global supply chain business, and increasingly I think shipping will be thought of as businesses, not as ships. So we won't be talking about just the dry bulk sector, we'll be talking about something else, although that may be the one sector we do talk about. But it'll be different. Clearly regulation has to take place in shipping through the assets in some way. But I think from a financing perspective, with consolidation in the container sector is the obvious one. The ships will get financed. They will be more predictable maybe in their value. We worry less about the asset. We will be focused on the earnings of the business. And so those sort of issues that were more important 10 years ago will be much less important now. There are safety issues about those sort of ships, which is a different thing. But from financing, it'll be financing the business, not the ship.
Sort of a focus on the relationship with your customer.
Well, that doesn't change.
Right. Evan, do you?
I just in the mid 2000s there was so much focus on the Panamax, the 4250s, and there's a lot of banks that are still holding an enormous amount of residual value risk on assets of those types, which are a trickier asset class today. I think if you're operating outside of the pure liner space, you need to really work on minimizing your residual risk on assets like that. I think the pace of change within the container shipping space is quite rapid, and it's hard to know if these 22,000 behemoths will be the ship of the future, or it will revert back to, I don't know, a 10,000 workhorse. It's quite unclear.
Yeah, it's basically bank financing principle. If there's not a lot of liquidity in your asset, you have to stay away from taking risk on that asset, because you'll get it when nobody else wants it. That's rule number one. So you have to be able to rely on your client, on their balance sheet, on their probability of default.
Okay.
Yeah.
We're going to, because we're getting near the end here, turn to an assessment of the future of shipping banks. And I was going to ask this question initially, but I'm going to ask it here at the end. Why is your bank in shipping? And for Martin, is your bank going to stay in shipping?
We also do aircraft finance. No, listen, we're a very special animal. We do ship and aircraft finance only, so we live with the assets. I definitely think we're going to be staying in shipping. That's not to say that there may be changes, maybe on the shareholder side. I mean, there's a lot of gossiping on that. I think people at DVB are far more relaxed because that's always been the case. Not many people know that, but there's always been talk of, okay, are you core to your parent company? Somebody else wants you. So in that respect, not a lot new. Listen, it is an organization with over 100 years of experience in this market, with people that have been there for a long time. You can adjust your risk appetite and still, have the people to go hunt for deals based on that new risk appetite, because the players are still there. The industry needs capital, so you are a fantastic conduit to do that. So yeah, we're going to be there.
Evan, I'm going to go in reverse order. Why is DNB in shipping? Although it's almost.
Well, I will take a minute for a quick update at DNB. We've recently reorganized three of our most prominent international industries, energy, shipping, offshore, and logistics, and actually seafood, into one global industry called oceans, the oceans industries. And in part, it's, I think, a next century vision of Norway to think about how the oceans sustain us, what we're doing within the oceans. But shipping is core to DNB's identity internationally. It's part of the bank's DNA. And I think that the implementation of this new oceans division, particularly with the insight that we feel that we can gain from our energy colleagues, understanding energy both up and down the value chain, will be even more powerful for our clients going forward.
Michael?
Citi has been in shipping in modern sense for 70 years. Citi Bank, through Walter Wriston, along with the old Chase Manhattan and David Rockefeller, were really the founders of modern ship finance. And Citi was pretty well the only American bank in the late 80s to stay in the business. It went to the board of directors of Citicorp, who made a conscious decision, given the relationships we had around the world, that we should stay in the business. But we've had to adapt, obviously, as an American bank, to the needs to fight for our share of the capital and also to make the right returns on that. So it's been a business that has evolved, and obviously with the creation of Citigroup in 1998 also occurred at a time when really the second wave of access to public markets, particularly equity markets, happened. So as an institution, we are, in our view, very well placed, and I have to go in front of senior management to justify what we're doing, particularly in a period of crisis. We are, of course, the most global bank in the world, which also fits very well with an industry like shipping, which, of course, is the most global of all industries. What I feel is that the shipping industry is changing. Citi remains well placed for that, and so I expect us to remain in an industry that is really evolving into, one that will serve the 21st century industrial society very differently from what it was really in the 20th century. And that's actually my 30 years in shipping and 40 years in Citi. I feel today is probably the most exciting time we've ever had in the shipping industry.
Yes, and a big yes for ABN. We are in shipping, we continue to be there, want to grow. We have also reorganized by adding logistics to our transportation business, because we think not only that we should continue to grow on traditional shipping, but also on adjacent businesses like port terminals and other logistic services. Why? Because I think I described that. I think it is attractive when you have fewer and fewer players, or basically alone sometimes on some transactions. This is attractive. So we've been in shipping for a few centuries. We'll be there for a few more centuries for sure.
Okay. Well, I see we're out of time, so I'm going to wrap it up. I'd like everybody to give a round of applause for the panel.